Right, we'll run through the main bits of info you need to know on each bank and also where the opportunities are on each of them. So Bank of England, first up. What's the main things you need to know? There are 9 members of the Bank of England MPC committee. So these are the people who make the decisions, and they make the decisions via a vote. So that becomes extremely important and becomes a trading opportunity. Their target is 2% inflation. Now this is symmetrical, which means it can go above and it can go below, either of which can produce some kind of policy shift. So they're the 2 main things you really need to know about the Bank of England. In terms of where the opportunities come or the way they structure their policies, you get the QIR, which comes every quarter. And this brings with it also a press conference with Q&A. Presser, Q&A and forecasts. So generally you get a little bit more information on the QIR than you do on any of the other meetings or the other 4 meetings. So where's your opportunities? You get a screen dump with the Bank of England. This comes at midday. And the good thing with this is it's reasonably clean cut in the way it displays the data and also the priority in that as well. So first up you get the rate, you then get the vote, you then get guidance, and then on every other you get the forecasts. And you can pretty much trade the Bank of England in terms of priority following the order that things come out. First up, obviously, the rate, and that is what's going to make the biggest difference. The vote, though, if the rate is as expected, then starts giving you clues, and that's the key thing from the vote. You get a clue. Are they starting to shift towards more hawkish or more dovish stance? Now, when it comes down to the language, the Bank of England really focuses on 3 areas. They have their main guidance, and their main guidance is that any rate increases will be gradual and limited. So that's their main guidance. However, the other areas that you get information on are on inflation, on stimulus, and on pricing. The Bank of England often on pricing will talk about how the market has got it, and so is the market right or is it wrong? So again, you get reasonably clean cut trading opportunities on these. The Bank of England could say that the market has overpriced a rate hike, or that the market is pricing in more or less rate hikes than should be expected. On inflation, this generally revolves around tolerance. And on stimulus, it's about whether they are willing to withdraw or maintain. So they're the focal areas for language. Remember the table as well. Get these noted down so you can see the progression over time. And that way, that starts to help you out in having a sense of what is likely to happen at the subsequent meetings. Moving on to the ECB. Now the ECB is somewhat different to the Bank of England in their mandate is only focused on inflation. And also that is inflation at close to but below 2%. Unlike other central banks that are willing to see it above and below, ECB is all about close to or below 2%. Now what you get from the ECB is you get 2 opportunities per month. You get the 12:45 and 1:30. So you get a screen dump, and you also then get the statement and press conference at every meeting. with Q&A. So this perhaps is the central bank with the most opportunities or the most likelihood of change. However, historically, they've only been changing when you get the staff economic projections. So these come again quarterly. So they come in March, June, Sep and Dec. So that's likely the time where you get change from the from the ECB. However, it's the interim meetings where you often get the most opportunities. Now this comes in their form of guidance. Now the ECB has very clear phrases regarding rates in that they will remain at present levels beyond the horizon for asset purchases, and that the asset purchases will run at a certain amount until a certain date. So still with the ECB, they still have in place at time of speaking QE and negative rates. They have generally been the slower to react and follow many of the other central banks in how they've done it as well. So you could have some clues from other central banks here. Now, in terms of guidance from the ECB, it's very much about keywords in their statements, and also the statement structure. So a statement in the press conference that starts off away from the standard structure, so make sure you read the statements. Anything that goes off the standard structure is almost always indicating change. And then it's a case of what exactly they've done. Now, the change is often already quite well known. The ECB on the non-quarterlies, so the ones outside of this bracket, will often then give the market a clue with the use of certain phrases, evaluating, analysis, and reassessment. They use any of these phrases, generally it indicates that you then have the next meeting a change. So that's a change coming. And this is where with the ECB, being aware of where exactly they're moving and which direction, it's quite easy to then take this phrasing on evaluating, analysis and reassess to mean that a change is coming at the next meeting, and you know the direction that that change is coming. Now, the other big opportunity you get from the ECB is sources. You consistently get unnamed sources outside of ECB meetings that give a sense of where the ECB is thinking that it's going. It will then enable you to have not only a chance of a trade in between meetings, and this is a trade that comes, as you can see on this example, at random times of the day. So not everyone is quite as aware of it, so this provides a completely different trade. However, the sources also then provide you a trade in that they may or may not be true. And there then becomes a trade on that as well. So your opportunities on the ECB, keywords particularly relating to policy and also inflation. That's the main focus, policy and inflation. Followed by that, you've then got the structure of the statement, the way this starts off, and then the use of keywords, evaluate, analysis, reassess. This tells you that change is coming. Finally, you've got sources as well, which give you opportunities in between meetings. So moving on to the Fed. Now the Fed is generally the most aggressive and quickest to act. So the Fed has already done QE and come out of it. They've already started raising rates. So the Fed leads the way and often provides a lot of format, structure to how other central banks may well follow on. So provide a template. With the Fed, again, you get 4 meetings with a press conference and forecasts. These also include, crucially, the dots. And this has often been the biggest tool in guiding the market on where exactly the opportunities are. So I've got a nice example of dots down here. This is how they actually come out. It gives you a median view of where rates are expected to be at certain periods down the line. This way the Fed can guide the market without use of explicit phrasing. The Fed does, however, have guidance in terms of rates, and that rate moves will be gradual. Again, sticking with the Bank of England, or the Bank of England actually adopted the Fed's phrasing here. Key areas outside of the dots that you want to be looking at. The Fed will use reference to 12-month inflation. Risks to the outlook. Monetary policy stance. This is crucial. So how do they phrase this monetary policy stance? Through the beginning of the rate hiking phase from 2015, the stance has been described as accommodative. But how they then continue to describe it will give a sense of how likely the Fed is to continue raising rates, or whether they are then into a phase of staying still on rates and that they are now at the neutral rate for inflation. That neutral rate is crucial as well. The Fed has a big focus on the Phillips curve. So make sure you understand what the Phillips curve is. It's the relationship between inflation and unemployment in the short term. One final thing, you get Fed minutes, and the minutes come 3 weeks after the meeting. Within the minutes, you get a use of various phrases, so watch out for the specific qualifiers, and this explains the severity of how people are voting for certain things. The Fed typically uses the words few, several, many, and all/generally. This is how the Fed then gives you a sense of where they view things going forward, and it's a chance then to also indicate to the market whether it was right or wrong at the last meeting by putting in certain elements into these minutes. So that's where your opportunities really come on the Fed. It is often a case of once you get the rate, the dots then become the main thing. So you get a rate movement, and perhaps you get quick move up on rates unchanged, followed by a very quick drop back down. And when I say quick, this is a matter of seconds. You get a quick move and then the possibility to fade that move on the dots. So make sure you're thinking about the relationship between the two and the order in which those come out. Now finally, on to the Bank of Canada. Now Bank of Canada is perhaps the quietest of the central banks that we look at. What you do not get from the Bank of Canada is any guidance. Unlike the other central banks that give some form of guidance, even if they're not explicit on what exactly it is. You get no guidance from the Bank of Canada. The Bank of Canada has also been very reticent to actually do anything on rates. So they've had no QE. Instead, just a verbal commitment. So Bank of Canada works on potential rather than action, or so far at least has. You also get very limited talk between meetings as well from the Bank of Canada. So your opportunities really do all come down to the screen dump. That's where your focal point is. On that screen dump, that's where you get all the information. You do every 4 meetings of the year get a press conference with staff economic projections. However, all the focus generally is on the screen dump. Now, the Bank of Canada is quite influenced by oil prices, so that can help give you a gauge as to whether rates may or may not be in play to move, and they're perhaps influenced in this to a greater extent than any of the other central banks. Now, they also, like the Bank of England, have some reasonably consistent phrases or areas of discussion. So these focal points. And these focal points of the Bank of Canada come around their outlook. And this is for Canada and global. That they can use as a reason to change rates. Beyond that, they also frequently reference excess capacity and labour market slack, giving you a clue as to how they're seeing inflation moving. Beyond that, they do also reference inflation as well. So remember to keep an eye on that table, keep an eye on how they talk about each of these areas. That way you again get a sense of how things are building. Now, the Bank of Canada's statements are inconsistent. A lot like the Bank of England, they don't have a consistent statement format. So it is again so much down onto this screen dump. Bank of Canada also is data dependent. Like most of the other central banks, but this then brings into focus certain CPI and unemployment rates in Canada, which can then start having quite a decent impact on rates. Bank of Canada is not scared to change mid or in between press conferences, so no presser, and they will still change. So every meeting is live, whereas what we've seen so far from the Fed and the ECB is generally that without a press conference there is unlikely to be a change, so they are not live, whereas the Bank of Canada, they are live at every meeting, and that provides great opportunity. So that's your central bank's quick wrap up, the areas that you need to be looking at. Make sure you track their references to data points, to how they see the economy evolving, to how they see rates evolving. Understand those keywords, break them down into a table. That way you can track, and also that way you can prepare yourself so much better for any of these events. Right. Okay, so the preparation for any central bank is all about a process. The whole point of it being a process is that it makes it easy to replicate. It means that you don't miss things. It means that preparing each stage doesn't miss anything and gives you the easiest and clearest way to prevent hesitation, prevent uncertainty come the event. Now, this process will then give you all of your trade opportunities that you need. If something doesn't come up in your process and does happen in the event, well, if you haven't planned for the trade, that's fine. You don't have to trade every single event. Now, the process works like this. First up, you want to be looking at your last meeting. We'll go through each of these individually. Last meeting first, followed by what the expectations are. These come from analysts, what the market's pricing. That tells you where your opportunities are going to be. Next up, what these opportunities are. So where the trades are, what exactly is going to have to change for you to actually get into a trade. So you can now see the opportunities. You now need a plan. How are you going to execute these trades? What's going to mean that you react immediately? What's going to mean that you take a bit of time to think about what's been said, what's been changed? Create your trade plan. So build up these ideas. Then it's a case of execute. Your execution matters as well. You need a plan for your execution as much as you need a plan for your trade. If you can plan your execution, this cuts all the hesitation. This is where you can maximize the trades, because if you have no doubt on exactly how you're going to do the trade, you put it straight on, you can get the correct size on, and that way you maximize your trades. Perhaps the most important part, the debrief afterwards. This consolidates everything you've seen. This is where you can learn a bit more about the way you've traded, about what's been said, about the way the market reacted. Done in real time, this is fantastically helpful, whereas if you look back at a previous meeting and just try and work out what happened, you miss small nuances, you miss the important little bits of information that the debrief will keep for you. Debrief, therefore, makes the review of the last meeting much, much easier, gives you a much clearer idea of what happened, and then helps you out in formulating trades for the upcoming meeting. So that's the process. Let's go and have a look at how exactly we do this. So, previous meeting, what you're focusing on really is three key areas. Policy, how it changed. But perhaps more importantly than how policy changed is market reaction. Did the market agree? Did the market disagree? Because the way the market reacts could impact decisions going forward from a certain central bank. So if the market totally disagrees with the policy change, one, it tells you that the central bank could react to that market reaction, but also shows you that the market was potentially completely not expecting that change. And then finally, in terms of clues going forward, any kind of language adjustment, any kind of phrasing, these provide you clues, and that will help come up with new ideas for your next central bank meeting. So that's what you're trying to take from the previous. Policy change, market reaction, language. It also helps you just remember how things traded and gets you in that frame of mind. So next up, expectations. First up, you want to be looking at pricing. What's the market pricing in? And you can do this via OIS, overnight index swaps, or via short-term interest rate markets. What you're trying to gain here is when the next action is. That way you can tell if something happens at the current meeting, whether it's too early or too late, and then how the market is going to react. So this is all about gauging reaction. And telling you where the most important trades potentially are. So once you've got the pricing, you then want analyst research. What this tells you is what people are thinking coming into the central bank decision. So it's where the areas of focus are. Because understanding what others are doing and what others are thinking, again, helps you create your own types of trades. Think about whether the focus is hawkish or dovish. Because this often goes across the board, that you'll go into a central bank meeting with the whole market thinking that you're going to get a hawkish reaction, and so therefore all of a sudden anything dovish becomes so much more important. But being very aware of what all the research is telling you and where everyone is leaning creates some of these outlier opportunities. And by thinking through those, you then spot those opportunities that are really going to pay off, and they're the ones that create the large moves, they're the ones that create the biggest opportunity for you. But if you don't go through and understand how the analysts are viewing things, how people's sentiment going into the event is, then you're not going to be able to pick out what those outliers are. So that's your building a picture. This is all just building up facts. You know, you've got the facts from the previous meeting, you've then also got the facts from expectations and developments. So next up, this is where you're starting to build up an idea of where you're going to get a trade in this. So what you want to be considering is how markets have moved since the last meeting. So this is the sort of preamble, what's happened recently. So say, for example, you're looking at the euro and you're looking at yields. And going into the next meeting, you've seen the euro start to drift on higher, whereas you've seen yields trade reasonably flat. So what this is saying to you is, right, well, there could be opportunities here, and it allows you to start thinking about which market is perhaps going to be more sensitive and in which direction. So clearly this move higher in the euro is, to a degree, pricing the idea of potentially more contractionary monetary policy. Therefore, perhaps the easier trade in the euro is going to be a sell, because of the fact that you've got a lot of positioning going into this, whereas in terms of yields, so if you're trading bond markets, very limited pricing, therefore they could be a little bit easier to move in either direction. Next up, data. Has it gone up? Has it gone down? Now, this is only going to matter if a central bank is very data dependent, so it's what impact this has had on markets and whether that's starting to skew people's ideas. So that's going to be a key thing. What you could have there in terms of data is that if data has started to improve, all of a sudden there is an expectation that perhaps rates could rise, and you start getting this hawkish expectation just because of a few data points. Think about the Bank of Canada did something very similar to that recently. So you've got market moves. Check out your data, understand where the economy is going into these movements, and then commentary. Now this is from central bank speakers, this is from sources, so it's direct commentary. It's not analyst expectations or analyst thoughts, it's actually what the central bankers have been saying. And what you're trying to gauge here is sentiment. You will often get a sense that central bankers will all start moving in one direction, more hawkish or more dovish, into a decision. This way, giving a sense of where the central bank wants to go. So first up you go in sentiment, then we get onto specifics. Has anyone actually given a date? Has anyone said something very clear on policy? Because if so, you've now got the opportunity of either a denial or confirmation. And that's where the opportunity lies there, in understanding the specifics in the commentary from certain central bankers. And one last thing, by tracking the commentary as well, possible language change. So is it that central bankers are starting to use a very familiar phrase that seems to be popping into a lot of their speeches? That way, this could then start to appear in the actual statement. That could be the new language that gets used if there is to be any change. So again, that then starts to build up a trade. So you've got really 3 trades potentially here. You've got language, you've got a denial and a confirmation of any previous specific commentary. So very, very important to start building yourself up ideas of where you've got certain trades. In terms of market moves, it's all about understanding which market is more likely to move on a certain event. So you've had a look at what markets have done, commentary, and what the data is. Next up, you want to be really drilling down on where specifically your opportunities are. So your opportunities generally are going to come from the statement. So, for example, what areas of the statement are you going to be looking at? This is an ECB statement, so you may well be looking at the number of purchases or the size of the purchases and their pace. Any key words that they use, any specific phrases that are used from central banks, that's what you're trying to take from the statement. Therefore, again, you can start picking out areas that can change. First up, will the 30 billion change? Next up, or firstly, will well past horizon phrasing change? All of a sudden, you're now starting picking out, if this changes in one way, you've got a trade. If it changes another way, you have a trade. And then we've seen the market moves coming into it. Now what you're looking for is specifics on where you've got an opportunity for a trade. Now if we take a quick example of a market, you'd be looking at this thinking, right, well, we've got a double bottom on here. Have we got a trade opportunity on a break of this double bottom and continuation lower? We're already in a reasonably weak market. The market seems to want to go down. So if we get something on the hawkish side in a bond market, is that going to be sufficient to break this double bottom? And where's the trade in that? It's not just about we break it, but this is where your trade plan now starts to think about where exactly is the trade in this. To the upside, quite a bit of resistance. So it does mean that you're going to need a fair bit of news to actually start bringing this market back through areas that have already been traded. So this straight away starts to give you an idea of probably you'd be preferring a trade to the downside rather than a trade to the upside because of the market structure. That's going to help you in terms of deciding on what trades you want to take on and how you're going to take those trades on. Okay, so build up your trade plan. So in your trade plan, first up, you want to categorize the trades that you've got. So you may have a trade around language, around the rates, around some type of market pricing, around a denial of commentary, and these will all fall into one of 4 categories. You first up got a binary trade. This is going to be a trade that has one of 2 outcomes. So very clean cut, it either is or it isn't something. Generally, this is a trade based on the rate or policy specifically. Next up, you've got a specified binary trade. Now, the specified binary trade is one that has numerous outcomes that you know. However, only perhaps 2 of 4 outcomes are important. So this is something that perhaps is on a vote count, whereby certain voting pattern will be important, other voting patterns won't. So it is binary, but only on certain events. You then have a varied outcome trade. This would be something on forecasts. So if you're having a trade off the forecasts that the bank presents, what you're trying to gain here is you can't tell whether the forecasts are going to be slightly better than expected, a lot better than expected, hence the varied outcome. And so what you've got to start deciding here is how far out of line have the forecast got to come before you can then start to decide on a trade with this. So this is all about severity. And then finally, anything interpretation. This is a language trade, so you're looking for specific changes, and that's where you get a trade there. If you're not looking for a specific trade, and again this would then link back to severity, you'd have specifics, and then there would perhaps be a slower trade where you get a sentiment. So is the language more hawkish or more dovish? Now this is a trade that you would plan to be taken on a little bit later. So you've got your ideas. Now categorise every trade. Know exactly what each trade, what category it falls into, 1, 2, 3 or 4, and how this may well change the way you actually execute these trades. So in terms of execution, first up, particularly looking at a binary trade, you're going to have a hit and hold trade. So the idea of a hit and hold trade is this is news that is game changing. You're going to get a very fast move to start with and then a continuation. What you need to be thinking about with a trade like this is where exactly you want to be in. This is where those levels came. If we looked at that previous one, if you have a level on this red line, your aim is to be in before it. If you can get in before the level, then you're happy with the break to then allow the trade to continue. If, however, you can't get in before, this is where you now start thinking about a continuation trade. Continuation. And what you want to be looking for a continuation, you have two types. You either have the passive continuation, where you're looking to buy a level on a pullback, perhaps a pullback to this red level. Alternatively, you're then looking at breakout continuation to buy the break of this previous high. So you have two types of continuation trade. This could also be something that gets used on a sentiment trade afterwards. You start to realise that the market is believing a certain sort of sentiment from the interpretation and gives you another chance of a continuation trade. Finally, the other trades that you have is a reversal. Now a reversal comes in two forms. You either have a reversal that again perhaps could come on a sentiment idea, perhaps you get a change in policy, but then sentiment is very much the other way. This type of reversal, you're looking for a move that builds higher, starts to pull back, and then breaks lower. And a bit like a continuation, you then have this trade breakout continuation through this low, and then you get the move back down. Whereas with a fade, rather than a reversal trade, you're looking for a specific piece of news that perhaps is enough to move the market, but not enough to keep the market going. So what you're looking for is a move perhaps up to a significant level on not so significant news that then gets traded back. So you're looking here, this is all about price action. You're looking for the market to slow down. You're looking for activity to stall. Therefore, you can sell it at the level for the quick reaction back down. So for every trade that you have, know exactly how you're going to execute that trade. That's going to be very, very important. It reduces hesitation. It stops you thinking, this was quite important, but now I've missed the hit and hold trade. How am I going to deal with this? What am I going to do from here? So be very clear on how you're going to execute every trade, what each trade's execution is going to be, and that way you do not hesitate and you do not doubt yourself. You should all have this breakdown now. This way you can just get all your trades down. Makes it very easy to track your trades, to be able to then go back and even sort of tick off the trade and go, right, that was the trade. What was the trade type? It was a hit and hold trade type. Perfect. So you now know exactly the type of trade it was. You now know what caused the trade as well. These may all vary in terms of data for each central bank and what exactly they're focusing on. But remember, get this all filled out. That way you can just go through it just before the event. You can go through very quickly and get in your head each of the different trades that you want to take. And that way it makes it a lot easier to pick the trade and take the trade on. Finally, your debrief, and this is perhaps, as I say, one of the most important parts and something that gets missed often. The whole point of your debrief is firstly to get down the facts. What happened? And also how this happened. And what I mean by that is the way that the information gets released. You may well look back and say, oh yeah, well this and this happened, there must be a trade on that. Now, as we all know, looking at a market after something's happened, it always looks like a trade, but perhaps there isn't a trade. So look at what the facts were, what happened, and also, did you get any clues going forward? What this serves to do, not only does it solidify what's happened, it also makes the preparing for the next month so much easier. Next up, trade ops. So what were the trade opportunities out there? And this isn't just the trade, was it a hit and hold, was it a binary trade, was it a specified binary trade? It's all of the opportunities. So for the next 2-3 hours here. So did you get a hit and hold to start with, followed by a reversal, and perhaps this was on a binary trade. Oops. However, language created a sentiment reversal. You get the movement the other way. This way you can go back and you say, okay, right, well, we got a market that fell. It then bounced, consolidated, and then we got the reversal and you got this break. And that way you look back and you start going, okay, there was a lot more opportunity in this than perhaps you might have thought on this initial move. Maybe this was 2 hours later. But you start then going into the next meetings thinking, right, I've got a lot of time to concentrate here. You know, the trade opportunities come later on as well as on that very first move. And then finally, question yourself. How did you trade it? Could you improve your execution? All of these types of things. Where were the additional opportunities? And also your mindset. Were you fully prepared for it? Did you react in the way that you wanted to? So you can go back, you can look back at everything you've done in the preparation and say, okay, yes, I had it planned, I executed it exactly right, I executed just how I expected to trade. However, my mindset was perhaps a little bit hesitant. I got the execution in right, but I rushed out of the trade. So question all of those elements. That way, you start finding new ideas. You start picking out how you can improve, but it also allows you to find new trades. So that's how you want to get your preparation done. And remember, this is just one big cycle. The debrief starts to inform you as to what happened on the previous meeting and makes your preparation for the following meeting that much easier. Okay guys, let's have a look at what central banks do. We'll do a quick run through, brief summary of how they work, what their functions are and the tools that they use. So main functions of a central bank. First up, they print money. So the central bank is the only person or the only institution that can print money. The importance of this is that they then can control the money supply, whereas if anyone can print money, you could then end up in an inflationary situation where people just print money whenever they need it. So the central bank having control of the money printing allows them to control the money supply. They are also a regulator. Now this will take differing form depending upon the country that they're in. Certain central banks have greater regulatory powers than others. Managing FX reserves and in some cases managing the currency as a whole. This is the case with perhaps the Bank of Switzerland that used to have pegged rates. The Bank of Japan tries to manage their currency at least verbally by talking up their ability to buy more or sell more of their own currency. So central banks will aim generally to peg their currency to a dollar. Is the typical way if countries are intending on managing their foreign exchange. Now the key thing that we're looking at is monetary policy. That's where the trade opportunities are. That's where your money can be made on central banks, and that's what we're going to tackle. So that's your key focus. Let's go and have a quick look at what the aim of monetary policy is, and then also how they go about implementing monetary policy. Right, so monetary policy, what's the aim of it? Aim of monetary policy varies depending upon banks. Not banks, well, bank, but also the country that they're in. Generally, and the easiest way to sum it up is to control inflation. However, certain central banks will have differing targets for inflation and also other elements that they need to control. For example, some will have unemployment, growth, and stable prices as aims of monetary policy as well. And this varies, as I say, between central banks. Generally, it comes down to an inflation which is often a target of around about 2%. So understanding each central bank's mandate is the most important thing. Certain central banks will have a mandate that is purely inflation based in terms of, say, the ECB, whereas the Fed has a dual mandate where it is looking at stable prices and low unemployment. So understand the mandate. That will then tell you which of these numbers you need to be paying most attention to. Inflation is clearly the key factor for the European Central Bank, slightly different for other central banks. So how do they go about achieving these goals? And this all comes down to monetary policy. So monetary policy has two key areas, or traditional monetary policy does. There is either the setting of interest rates or the control of the money supply. So we'll go and have a look at those in a moment. Rates come generally for many central banks in three rates, and we'll talk about how exactly these work out in a minute. And the money supply element, this is done through repo operations. And so that injects or withdraws liquidity from the system. So let's go and have a look at how exactly these work. So when you come down to interest rates, a traditional way of looking at it, or perhaps a simplistic way, is that central banks will have three key interest rates generally. There will be the refinancing rate. I'm using the terminology from the ECB here. The deposit rate, and then either a discount or marginal lending rate. So how does this all work? What you have, you have a refinancing rate which generally sits above the deposit rate. Now, the aim here is that there is no incentive for commercial banks to participate with each other outside of this boundary. Typically around about 5 basis points, so 0.5% wide. Now the reason for this being, if you're a commercial bank, you need some cash overnight. Perhaps you've got transactions that need to be fulfilled, so you need additional cash overnight. You can borrow money from the central bank via their repurchase operations, which we'll come on to. So there's no reason that you're ever going to borrow money from another bank at a rate higher, so up here, because you could go to the central bank, which is a much more credit-worthy counterparty, and so one where you're not exposing yourself to so much risk. Likewise, if you have excess funds, you can lend them to another bank, or you can deposit them at the central bank. So again, there's no reason that you would lend funds down here because of the fact that you could put these funds at the central bank, which again is a much safer counterparty. So why doesn't the rate between banks for overnight lending sit or fluctuate so wildly between this range and more likely sits reasonably close to the middle of the band? The reason for this is the central bank's influence on money supply. So how do they go about this? What the central bank serves to do is either inject money or withdraw money from the economy. So the way they go about this is via their repos, repurchase operations these are. So you have two types of repo. You have a standard repurchase operation, and you have a reverse repo. Now, the key thing to remember here is one serves to create money, whilst the other serves to destroy money, thereby managing the supply of money in the economy. So how does this work? What happens in a repo? Central bank prints money. We use euro in this example. They then buy bonds generally or high quality securities from a bank with the agreement that at some point in the future the bank will pay the money back, the central bank will hand the security back. That way, for a short period, money is created. This could be as overnight rates are starting to move up here. As they start moving higher, the central bank will conduct more repurchase operations. They will conduct them almost every day anyway, but they may conduct more repurchase operations in order to bring this overnight rate down. Now the reverse repo works in the exact opposite way. So the central bank sells securities to another bank. The commercial bank hands the money over, and this money effectively comes out of the system. It is effectively destroyed. At a time later, back it goes, and back it goes. So the money short term is destroyed. Now, what the term for this activity is this additional liquidity created in a repo is then effectively sterilised, and that's the key thing here, that the central bank is not printing new money, it's short-term creating liquidity that it then sterilises. The liquidity goes away and the economy or the short-term rates move back to normal. So it's all very much a short-term increasing or decreasing the money supply. Now, where this all starts to change is when you then move on to extraordinary measures, which is something central banks brought in a little while later. The reason for extraordinary measures is because you've got to a situation where the refinancing rate has dropped, deposit rate has dropped almost to very similar levels, and the refinancing rate has reached around about zero. So what you've now got here is the central bank cannot reduce rates any further to stimulate the economy. The whole point of reducing rates is to help inflation stay towards that 2% target. So what do? If they're not dropping rates anymore, how can they move on to this? And this is done through extraordinary measures. Now, the first and most obvious extraordinary measure is QE. The way QE works is the central bank buys bonds, and crucially, these are unsterilised. Meaning that the money printed to buy the bonds doesn't then get taken out of the system again via an agreement that would happen in a repo, whereby the bonds bought would then get sold back. Unsterilised QE bond buying, the central bank will print more money, buy more bonds. Now, what this serves to do is pushes up prices and it pushes down on yields. As yields go down, that therefore means borrowing costs generally are reduced, and so then serves to further reduce the cost of borrowing for banks, for the government even, because any new bonds issued would then be issued at a lower rate as well. So that's the point of QE. QE has then developed in terms of its duration, its size, and also its scope. Whereby they moved into corporate bonds. Now, next up, swap lines. This was something that's done when liquidity is needed. Say, for example, a UK bank, so commercial bank, needs a lot of dollar funding. The Bank of England can then go to the Federal Reserve and effectively create a repo situation. There won't necessarily be a collateral switch, but it will be dollars lent short term into pounds so that funding can be carried out in the UK. So these are set up particularly in times of liquidity crunches to aid generally dollar funding, because the majority of banks will need some sort of dollar funding. One final thing after the swap lines is helicopter money. This is not something that has been done by any bank as yet, and that's why this is important to understand how helicopter money could work, because the fact that it's not previously been done, any new imposition of helicopter money could be very, very important and provide a very good trade opportunity. Now, the way they could do it is either they could credit accounts of individuals. So the public would get a credit in their bank account of X amount of money. The idea behind this is by printing money, and rather than buying bonds as you would in QE, you just buy, you hand the money straight to the people who will then buy whatever they want. This theoretically increases inflation. And in a deflationary environment, this may well be seen as the best way to do so, because the fact that individuals are more likely to then spend the money given, whereas in QE, the money goes to banks, which then use that to bolster their balance sheet and create a stronger looking position for themselves. The other way that helicopter money could be done is via what would be known as a zero coupon non-callable perpetual bond. So what this means is this is a bond that has zero coupon, i.e. 0% rate. It's non-callable. Therefore, if you buy the bond, you can't then ask for your money to be paid back, the principal that you paid for it. And it's perpetual, which means it does not have a maturity date, as with most bonds. For example, if you had a 10-year bond, you would know that in 10 years' time, you will get paid back the amount of the value of that bond. With a perpetual bond, there is no date, but you're also earning no yield on it either, no coupon, and you can't at any point ask for your money back either, so it's non-callable. What effectively happens here is that the central bank prints money, buys the bonds direct from the government, injecting money straight into the economy. So that's central banks in terms of what their aims are, the tools that they use to get there, and then after that, extraordinary measures that have been used in the past. Now, the announcement of any of these things is probably the single biggest impact on any market, and so understanding each of these areas, very, very important. We'll now go and have a quick look at a process for preparing for any central bank announcement.